If you're a property investor or landlord looking to secure a new property quickly, but you don't have time to wait for a traditional mortgage, then a bridging loan could be the solution. In this video, I'm going to explain exactly how bridging finance works, when it's useful, and what to watch out for. I'll also walk you through a couple of real-world examples so you can see how investors use bridging loans to grow their portfolios. What is a bridging loan? A bridging loan is a short-term loan secured against a property. It allows investors and landlords to purchase a property quickly without waiting for a standard mortgage application to be approved. Bridging loans are typically used when an investor needs immediate funding to secure a property deal before arranging long-term finance. This type of finance is commonly used for auction purchases, property refurbishments, or when a property is not yet mortgageable and needs work before a lender will approve a standard mortgage. Who uses bridging loans? Bridging finance is primarily used for property investors, landlords and developers who need access to funds quickly. Investors often use bridging loans when they need to complete a property transaction with a tight time frame, such as when purchasing at auction. Developers might use bridging finance to refurbish a property before refinancing it with a long-term buy-to-let mortgage. Some landlords also use bridging loans when purchasing properties that require structural work before they qualify for a standard mortgage. How do bridging loans work? The process of securing a bridging loan is straightforward but requires careful planning. First, the lender will assess the value of the property being used as security and the investor's exit strategy. The exit strategy is crucial because it outlines how the loan will be repaid. Typically, an investor will repay the loan by either refinancing onto a longer-term mortgage or selling the property. Once approved, funds are released quickly, often within a matter of days or weeks. The borrower will make monthly interest payments or in some cases have the interest rolled up to be paid at the end of the loan term. How is a bridging loan repaid? Bridging loans must be repaid within a short time frame, typically within 6 to 12 months. There are several ways to repay a bridging loan, including refinancing onto a buy-to-let mortgage. This is the most common repayment method. Once the property is habitable and meets lenders' criteria, the investor can refinance onto a longer-term mortgage and use the proceeds to repay the bridging loan. And then there's selling the property. Some investors take out bridging loans to renovate and then sell the property for a profit, using the sale proceeds to repay the loan. And then there's using other funds or investments. If an investor has access to other funds, such as equity from another property or business profits, they can use this to clear the bridging loan. It's essential to have a clear repayment plan in place before taking out a bridging loan, as failure to repay on time can result in high penalty fees and potential repossession of the property. So here are two clients that I helped recently use bridging finance to achieve their property goals. So John is an experienced property investor who spots a great deal at auction. The property is priced below market value, but it's not mortgageable because it doesn't have a functioning kitchen or bathroom. I arranged a bridging loan to buy the property and he then spent 3 months refurbishing it. And then I helped him clear the bridging loan by arranging a buy-to-let mortgage. The rental income from the property covers the mortgage payments and then John pays the bridging loan off in full. And then there was Sarah. Sarah is a landlord who wants to expand her property portfolio by purchasing a tenanted property, but she doesn't have enough liquid cash for a full deposit or to buy outright. The property is generating rental income, making it a great investment, but traditional lenders require a lengthy approval process. To secure the deal quickly, Sarah takes out a bridging loan, allowing her to complete the purchase before another investor swoops it in. She takes out a bridging loan to complete the purchase quickly before refinancing with a buy-to-let mortgage. Because the property is already tenanted, Sarah can prove to a buy-to-let mortgage lender that it generates stable rental income. After a few months, I then refinanced this onto a longer-term buy-to-let mortgage using this new loan to pay off the bridging finance. This strategy allows her to grow her portfolio without needing a large upfront cash investment. If you're thinking about using a bridging loan for your next property purchase, make sure you have a solid exit strategy in place. If you have any questions about how this works or if this is the right option for you, please drop a comment below. And don't forget to like and subscribe for more property insights every week.